the fact that the Fed is at a fork in this road where it's been kicking the can. And at this point, it doesn't matter which direction they kick that can. Either way they go, they're headed for disaster. Yeah, I own a lot of mining stocks, so my own portfolio, really got beat up this week. But it didn't bother me because I understand why this is happening. I understand that the majority of the investors out there that manage a lot more money than I do have no idea what's going on. And so they are just reacting based on, whatever their programs are for the economic data. They see this data, interest rates going up, the Fed having to raise rates, and they just think, okay, that's bearish for gold. The problem is they're not thinking several moves ahead, right? They're all playing checkers, right? I'm playing chess, and I see this through to the checkmate. I know how this game is going to end. I know that ultimately everything that's happening right now is bullish for gold and it's bearish for the dollar. And that's part of what's keeping gold down, is that the dollar is going up.
Renowned economist Peter Schiff delves into a dire financial forecast, dissecting the current state of the economy and exposing critical misconceptions. Schiff passionately discusses the Federal Reserve's precarious position, asserting that the market is on the verge of a catastrophic disaster, regardless of which direction the Fed takes. He candidly shares his investment strategies, particularly in gold stocks, emphasizing his confidence in the long-term game despite short-term market fluctuations. But hold on, because the most alarming revelation is yet to come. Schiff takes a deep dive into the housing market, revealing a shocking truth that defies common belief. He explains why the banks are in a far worse position now than during the 2008 crisis, painting a vivid picture of the impending financial storm.
But I know this is all a bunch of short-term noise because the traders that are making this noise have no idea what's around the corner. And again, remember, these guys had no idea that the 2008 financial crisis was around the corner, even though it was. And so it's the same people making the same mistake. So what I did personally to take advantage of this is I put a lot of the dry powder that I had built up over the last few months. I earn money, and I've been deciding not to add it into the market. I've been holding it in cash. Well, I put a good chunk of that to work this week. The majority on Thursday and on Wednesday. I actually didn't do any new buying today. I kind of stood back because the market's gapped up this morning, and so I didn't want to buy the open. And then, they kind of rolled over, and they kind of got back down to the levels that I bought yesterday. And I wasn't able to buy anything cheaper really today than what I bought yesterday. And so since I couldn't buy cheaper, I decided not to buy. But I bought quite a bit on Thursday and on Wednesday in the mining sector specifically. In fact, that's really what I was buying because those were the weakest stocks. And so that's where I wanted to buy, even though I'm already very, very heavily concentrated in the mining stocks. It is my single largest allocation by far, and has been for many, many years, because I'm confident in the end game. And that's why every time we have a rally in these gold stocks, I don't sell. I don't buy into the rallies. But when we get a sell-off, I take advantage of that, and I keep putting more money to work. So as far as I'm concerned, I'm happy that gold sold off because it gives me a chance to buy more gold stocks at a better price. And I think everybody else should be viewing it the same way. Because when this thing changes, when the people who don't have any idea what's about to happen find out, when they're blindsided by what happens, then they're going to be rushing to buy gold. And who knows? I mean, the price could move up hundreds of dollars a day, $500 a day. I mean, what's happening now is nothing compared to what I believe is going to happen when, that light bulb goes off. We get that emperor has no clothes moment where all of a sudden the masses recognize what should have been obvious, but wasn't. Like, it's obvious the emperor's naked, but nobody wants to admit it until some little kid says, hey, look, I don't see his clothes. And now, okay, the rest of them, can see it too. So I just want to be prepared. But here's one example, too, of that. Just take the housing market, because I hear this all the time. Well, the housing market, it's not like 2007 or 8 because we don't have, this big subprime problem. We don't have a big rise in defaults. And so, we're not going to have the same kind of crisis. They're wrong. The housing market and the banks are in worse shape, not houses, rather the banks, right? The banks are in worse shape and more vulnerable to the housing market now than they were in 2007 when everything collapsed and we had the financial crisis. Because the problem that the banks had in 2007, 2008 was defaults. Borrowers were defaulting on their mortgages. That was the problem. That's why banks lost money. If somebody didn't default, then the bank was fine. They just kept getting their mortgage. The problem was housing prices fell. And because housing prices fell, a lot of people decided not to pay because they had negative equity. Or a lot of people had adjustable rate mortgages because they got these teaser rates. And when the teaser rates reset, they couldn't afford it. Now, when they initially took out the teaser rates, they didn't even care if they could afford it because they just assumed that the house price would go up. And so they could refinance or they could sell and make a profit. So nobody really cared about what the future mortgage rate was. People just wanted to buy so they could jump on that train and get rich. So the problem was the banks had loaned out a lot of money with zero down or negative AM, and then housing prices went down, and then people started defaulting. And because of the defaults, the banks lost money. But the vast majority of mortgages didn't default. It was just a large enough percentage that it caused, insolvency at these banks. And now the Fed, everybody had to bail them out because, it's a fractional reserve system. The banks hardly have any reserves relative to all these loans. So now you have a few mortgages going bad, a large enough percentage, and that's it. They're all insolvent. What's happening now is very different, but it's actually worse. And this is what people don't get. It's not about default now. In fact, defaults would actually help. The banks would actually be better off if people defaulted on their mortgages. The problem is the mortgage itself.
In this next segment, Peter Schiff discusses the challenges faced by banks in the mortgage market. He explains that banks are losing money because they initially issued mortgages at 3% interest rates, but the rates have now risen to 7%. Even though people are still making their mortgage payments, the banks are losing money on every outstanding mortgage. Schiff points out that in 2009, when the Federal Reserve reduced interest rates to 1%, the mortgages held by banks that didn't default increased in value. However, despite the appreciation of some mortgages, the financial crisis still occurred. Today, the situation is different as very few people are defaulting on their mortgages due to the low 3% interest rates. Even if homes are underwater, borrowers are reluctant to let go of their 3% mortgages because it's a significant asset for them, but it poses a considerable liability for the lenders.
The banks are losing money on the mortgage because they wrote these mortgages at 3% and now they're in the sevens. The banks are losing money on every mortgage that's outstanding. So even though the people are still paying their mortgages, the bank is still losing. Remember, in 2009, the Fed slashed interest rates down to 1%. That meant all the mortgages that the banks owned that didn't default, they went up in value. Right? All those mortgages appreciated because the Fed slashed interest rates. So even though they had some mortgages that went bad, the mortgages that didn't go bad, which were the vast majority, it appreciated in value. And even with that, we still had the financial crisis. But today, almost nobody is defaulting. Nobody is having a problem making their mortgage payment because the mortgage payments are 3%. And even if your house is underwater, which most aren't, nobody's leaving. They don't want to give up their 3% mortgages because it's a huge asset for the borrower. But that means it's a huge liability for the lender.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.